All right. Matt, the mortgage guy, Monday, 3 p.m. Pacific Standard Time, answering all your questions, talking about the real estate market. Interesting stuff to talk about. The market is obviously shifting. Being somebody who's in it all day, every day, talking to real estate agents, talking to borrowers, I can tell you that, it's officially started to shift. The misconceptions come from people thinking that real estate moves fast, that shifts happen faster than they really do in the real world. 50, 60, 80,000 above list price on a $500,000 home, 17 offers in the first 3 days. That's the kind of stuff that has literally gone away in most of the markets in California where I do the majority of my business. It does not mean that something that's priced well, shows well, you're going to go out and be able to get a 10 or 15% discount on the first day it's listed, right? It's just not the reality. But really cool opportunity for home buyers, for real estate investors to actually go out there, have a little bit of leverage, possibly get some seller credits, be able to, keep contingencies in place and things like that. So I looked at some stats earlier. It's so interesting how one data set can be talked about in 7 different ways and give you 7 different opinions on what the real estate market is truly doing. One stat that I saw that I know is going to get a lot of attention is that in June, there was 60,000 canceled contracts. People pulled out of a contract on a home purchase in June. That represented 14.9% of contracts. It's a humongous number. 14.9% and 60,000 canceled contracts. If you look at it historically, and Redfin's got all this data over the last few years, you'll see that that number fluctuates between 12 and 13% month on month. So being that it's 15% in June doesn't really tell you that thing like cancellations are up 50% or 60%. They're up literally 10% or 12%. Which makes sense. I attribute that to 2 different things. And really what I do is I take stats that we all read and see online, and I make sense of it based on what I'm seeing and hearing from clients. Because as a mortgage broker who's licensed in 48 states and talks to hundreds of real estate agents every single month, I hear these stories firsthand. I talk to these borrowers firsthand. I'm not just reading a stat sheet from online. And a couple different things can attribute to more cancellations than normal. One, somebody got a contract on a new build 3 months ago, 6 months ago, and now we're getting closer to the, completion date of that new build or the close date for that mortgage. And if they weren't locked in and all of a sudden rates are up 2%, 3% from when they started, they might not qualify. So it might be a matter of even if they wanted to buy, they can't, right? Because they don't qualify. Might cancel for that reason. Another reason they might cancel is that as the market softens a little bit, maybe this isn't already showing up, but this is something that crossed my mind, so I'll share it nonetheless. They're actually able to cancel because there's contingencies in place. 6 months ago, last 2021 and 2020, you might have to put in an offer with a big earnest money deposit with no contingencies in place, and backing out of contract or canceling might have cost you tens of thousands of dollars, where people probably executed on contracts where they wanted to back out, right? In the case where we're actually seeing appraisal contingencies, loan contingencies, inspection contingencies actually as part of the contract, meaning if any issue comes up, you can back out and get your earnest money back. That might be a cause for a few percent uptick in cancellations because they can cancel without really any recourse, right? So interesting to see, interesting to watch. We'll see what happens with that number if more people continue to back out. Another contributing factor to that over the last few years with real estate really being on a tear, more and more real estate agents have got licensed. More and more mortgage professionals have gotten licensed. And truth be told, they don't all necessarily subscribe to the same model of being thorough, making sure somebody's pre-approved, making sure all the I's are dotted and the T's are crossed. And so stuff will fall out of contract because things were put together sloppily up front. I have clients and real estate agents alike who almost daily are like, hey, listen, can you give this person the green light? Can you give them an idea of if they qualify, we're going to write an offer. They don't need to be pre-approved. We just want to have you glance at their stuff real quick. That's not how it works. That's not how we operate. Full pre-approval, run credit, verify income and assets, make sure it's run through the automated approval system, make sure if it's complicated and there's restricted stock unit income, that we have an underwriter look at it. All those things need to happen, right? And if those things aren't happening, stuff can fall out. So another thing that might be a contributing factor. Okay, we can talk about pendings and other stuff. I'd love to jump into questions and really, like we usually do, take this in whatever direction you would like. Joey Garessi, first comment of the day. You are the winner. Good to see you, brother. I don't know if you're watching any NBA Summer League, but my buddy Keegan Murray from Sacramento is looking good. I was in Vegas last week with the family and got to go see Kings Orlando lost in double overtime in that Summer League game. But Keegan Murray looking good. The future for Sacramento Kings basketball is bright, brother. Hope you're doing well. Ramon Cisneros Cruz, hello. Hope you're doing well. Good to see you, brother. Good evening from Lakeland, Florida. Kevin Hawthorne, thanks for joining, brother. Clinton Roberts, can you go over recasting mortgages? Would be happy to. If anybody's interested in recasting, if you type in recast or what is a mortgage recast and Matt, the mortgage guy, on my channel, no doubt you'll come up with a video I made. It's a couple years old, but the gist of it, Clinton, is you've got your mortgage and you owe the bank $300,000 at this rate, and your property taxes, homeowners insurance, principal and interest, your total mortgage payment is $1,800. You, for whatever reason, maybe you receive an inheritance, maybe you win something in the lottery, whatever the case is, you want to throw a lump sum payment at your mortgage and then recast it so that you have a lower payment. That's generally what folks are looking to do. And maybe folks entering retirement, this makes more sense for them because they're on a fixed income and they want a lower payment. But in your case, Clinton, let's say you throw a $50,000 lump sum payment at your mortgage. And so, at the time you did it, you owed $286,000. You throw that $50,000 payment, now you owe $236,000. You can apply with most mortgage servicers to do what's called a recast. And you had 28 years of payments owing $286. And so that total payment was going to be $1,800. That's just a random number, but just for our example, you paid down $50,000. Now you only owe $236. You're going to make the same payment month after month. It's just going to pay off sooner if you don't do anything. But if you say, I want to keep paying it for 28 years, I just want a lower payment, they'll recast it over those 28 years, but based it on that new principal amount owed of $236, might lower your payment by a couple $100 a month. So that's essentially how it works. They're going to usually charge you something like $150. Know that it might take 30 or 60 days. Some people get frustrated. It's like, hey, I sent this $50,000 payment and I'm waiting for my payment to go down. It's taking them 60 plus days. I would prepare for it to take somewhere between 60 and 90 days because I've talked with many people who have done this. Yes, it's available. Most servicers will do it. It just takes 2 or 3 months to get it set in place. So that's that. Check out the video. If you have any other questions, feel free to reach out to me and the team. We're happy to help. Easiest way to get on the calendar to talk to a loan officer from the team is go to greatmortgagebroker.com. You fill out the form. Somebody on the team will get back to you within the next 24 hours. What is the difference between underwater and upside down? When it's referring to real estate, either one basically means you owe more than it's worth. If you owe $320,000 on a house and the house is only worth $300,000, some people call that upside down. Some people call it underwater, but the terms are the same. Last I heard, the percent of people that are upside down or underwater is so low. The average loan to value ratio across all mortgages is a ridiculously low number, like 42%. And for your example, underwater would mean over 100%. 110% would mean you owed 330 and it was worth 300. That'd be 110% loan to value. 42% loan to value means on a $300,000 house, the average person owes $126,000. Is that right? 42% of 300? 126? Sounds about right. Even if, I don't know the stat specifically, but let's say home prices went down 10 or 15%. The vast majority of people, vast majority of people would still have equity. They wouldn't be underwater or upside down, whatever term you want to use. Oh yeah, you guys got Chet, man. Chet Holmgren looking good. Matt Bittner. This is $1 million question, and I think that this is really market specific, home specific. It's a question that really is case by case and on a specific scenario. Like I couldn't say that, hey, December of 2022, lowball offers will get accepted. One, what is the lowball offer to you? Is it 5% lower than the asking price? Is it 10%? And then you go back to what's the asking price. The asking price is just a random number that the seller and the listing agent agreed. Let's put your house on for 600. If all the comps are selling at 550, and truth be told in this market, like they should expect to get between 535 and 540, they can list at 600 and your low ball of 535 feels like a low ball to you. It's what they should have listed at in the first place. Right. So you got to be careful there, but I think it's so specific to each property that you can't say, how much longer will I have to wait for lowball offers to start working? You should see it probably already on some properties out there. Example, there might be a property that's priced well, shows well, in a great neighborhood that gets into contract within 5 days. I'm thinking of a specific neighborhood in a real life example. In that same neighborhood, a house that's not as nice, hasn't been remodeled, it was priced too high to begin with, and it's just not marketed well, has been on the market for 44 days. Same market, same neighborhood, mispriced, doesn't show well. Priced well, shows well. This one sells within 7 days. This one might take 2 months to sell. It might take a price reduction or two to even get people to start looking at it, right? And so it's a very specific thing. Slowly but surely, the market's going to adjust. I saw something today that I really agreed with. I think 2023, based on all the supply demand dynamics, it's going to be a really flat year. There's going to be little to no price appreciation, which is going to be a good, healthy thing. Stuff is going to level off, and a specific neighborhood you're looking at, if a 3-bedroom, 2-bath sells for $500,000, there's going to be more to choose from, meaning more inventories out there. You're going to have longer before it goes into contract because things aren't going to sell as quickly, which is an interesting stat to look at. I'll share that real quick because I had that written down from earlier notes, the video I made for tomorrow. 2019 and 2020, the stuff that got into contract within the first 2 weeks of being listed, 37% of stuff, more than a third, got into contract within the first 2 weeks. In 2021, that number was 51.5%. So more than half of the stuff that was listed was sold within the first 2 weeks. 2022, surprisingly, we're still at 50% when you're looking at the 12-week average. You look at it from a smaller snapshot, 4-week average, it's down to 45.9%, but that's still well above 2019, which is the last pre-COVID year to look at, meaning that there's still quite a bit of demand. And when I look at inventory numbers, I see inventory numbers are up, but still not as high as they were in October, November, December of 2019. Woo! Thank you. Mailman said, bless you. So anyhow, interesting market dynamics to follow. How much inventory is out there and how quick things are selling. Omni Trader, how long do you have to wait to refi your home after close? And what's the refinance fees? Refinance fees are going to vary based on where you go, but expect to have lender fees, title fees. And then over on the other side of the loan estimate, you're going to have prepaid property taxes and escrow there. Not necessarily a fee, right? Really, the only fees are lender fees, title fees, appraisal, and things like that. The other stuff, you might prepay tax and insurance, but then you might get a refund of your old escrow account. That is a relative wash. What I would expect between lender and title, anywhere between $2,000 and $3,000 if you're not paying points. If you are paying points, then that would be above and beyond the regular, title might be $1,000. Some lenders are going to charge you processing, underwriting, other fees that can vary between $1,000 and $2,000. We can surely set it up with no lender fees at all. And a lot of refinances are set up that way just so that if an opportunity arises in the future to do another refinance or something else, you don't have all that sunk cost into lender fees. But multiple different ways to structure it. Really, you want to talk to a pro that's able to give you the best advice for your specific scenario and tell you how to structure it. One way to get a hold of a pro is go to greatmortgagebroker.com, fill out the form, let us know where you're at and how we can help. If you're in one of the 48 states that we're licensed in, we will reach out to you. If you're in Nevada or New York, we'll refer that to a great broker there. I know many of them. Elena Boland and Ben Lavender come to mind for those two states. AJ Kamoth, past client, great guy. How you doing, brother? Thanks for joining. If you're creating a living trust, you don't necessarily have to inform UWM. You can just continue to make your payments to the servicer. You're just going to have your attorney, whoever's setting up the living trust, make sure that they set up that living trust to where all your assets kind of funnel into that. You wouldn't necessarily contact the lender, but if you're creating a living trust for your family, you can make sure that they do a grant deed to put the title of the home into the living trust. So get with the attorney and make sure that they're able to file that grant deed for the title of the home. Not necessarily anything with the lender, but with the title of it. Yep. That's my best advice. I'm starting to see wholesale houses with with price reductions. So you're seeing stuff that people are wholesaling and they were asking for $240 and now they're asking for $230 on the wholesale side. That's interesting. Maybe these wholesalers are, stuck with some stuff that they might have overpaid for. It's a market where wholesalers, flippers, anybody who's doing that and turning things real quick, the pros are going to do well. The ones who were banking on all the appreciation and the ones that were riding this tidal wave of home price appreciation might be in for some pain. I know specifically some home flippers that have sold some properties at a loss over the last month or two. And you just can't expect the market to go up 2% every month. Over the last couple of years, double-digit home price appreciation, 20%, 25% in some markets. That's just not sustainable. It's just not always going to be the case. And so if you buy a home and you attach too big of a after repair value to it, you go over budget, it's really easy to lose money. That's why flipping won't be for the faint-hearted over the next 12 to 24 months. Only the pros are going to be able to do that. The ones that have systems in place and really strict buying criteria. Try RD dad, did I deed CFG? Thank you. Whatever that meant, thank you. All right, Clinton, report back to us after you watch that video. Throw a link here in the comments if anybody wants to see the video on what was the subject? Recasting. All right, I guess I'm on my HELOC kick right now. If I co-own a rental property with family and we're looking to get a HELOC, would all family that son, title, and first mortgage need to be on the HELOC? That's a great question. You guys are all on title. You can take out a mortgage in just one person's name if you qualify. And I would guess it would be the same for the HELOC. And just to follow up on our email conversation, Joey, when I filled out the form online for no name other lender, that 70% LTV was on an investment property. I was curious. So I put in the details for an investment property I owned, and they do a HELOC up to 70%. My guess or my thought would be that it should probably be 80% or higher if it was a primary. And just for everybody out there, home equity lines of credit, second closed-end second mortgages, these things are going to become really popular the second half of 2022. I guarantee it. With people sitting on first mortgages that are 2.75%, 2.875%, 2.5% in some cases that don't want to refinance, home equity lines on the wholesale side in the broker channel, I already know. I've heard it out of the mouths of executives. Those things are in the works, home equity lines of credit. So I'm excited to be able to offer those to clients probably mid-August because it makes more sense than doing a cash out refinance for 30 or 40 grand. Truth be told, it's not something that's going to be a moneymaker for the mortgage companies or the individual loan officers like myself, but will be a great product that makes sense for consumers. And then the hope, I would think, is that we would write these things and keep that close relationship with the borrower to be able to fulfill any mortgage needs in the future. 2025, 2026, rates get down to 3.5%, and we do a consolidation loan where we tie that home equity line and the first mortgage together. Something like that. Should be able to do it with just one of you, is my guess. That's how mortgages work. You can have 3 people on title and the loan can be in one person's name. I'm guessing HELOCs. Well, something would have to be signed by them, or else you'd be able to go do it on your own. They wouldn't even know, right? You'd pull out 30 grand. So yeah, I'd check. I'm not a HELOC master, not yet. Having a rate lock for 3 months until September with no float down option. Is there another way you would advise to get a lower rate without that lock or within that lock, or not really? I guess it depends on how good those terms are. This is my thinking face. I would just double check with a second lender. Feel free to send us whatever you have locked in, and I'll tell you what I think of that lock. What are you seeing with mortgage delinquencies? Are they increasing? Well, I'm glad you asked, because everybody talks about the market is collapsing, things are falling apart. Like every report that comes out just shows record lows for delinquencies. It's like less than 3%. I don't know if we've had a reading since May. I'm guessing June's is probably going to come out within the next week or two. But May's reading was like 2.75%. Serious delinquencies, where they're like 90 days or more past due, but not in foreclosure, are 45% higher than pre-pandemic levels, but down like month on month. So, foreclosure starts are down from April to May. They're down 12%. Let's see here. Prepayment activity. That's just people like refinancing. So that doesn't necessarily. Total U.S. loan delinquency rate, 30 or more days past due, but not in foreclosure, down 42% year on year, down 2% month on month. U.S. foreclosure pre-sale inventory rate, up 1% month on month in May, but it's still 0.33%, 1/3 of 1%, which is very, very low. You can't compare year-over-year stats. Anybody who shows you like pre-sale inventory on U.S. foreclosures are up 17%, or total U.S. foreclosure starts are up 400%. If you see that stat and someone's trying to sell you that foreclosures are like exploding, they're a complete idiot. There's no other way to put it. But there was moratoriums in place last year where you couldn't foreclose. So when you see 18,000 foreclosures in May of 22, it's like 20% of a normal month, right? Where there's 100,000 foreclosures. I don't know the exact number, but I know like historically it's way, 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 way below average. And so like it means literally nothing to look at year-over-year stats versus a year where nobody could foreclose. It's just a silly metric to look at. It's like, I don't know. I can't think of a really good analogy right now, but comparing anything versus a zero number when it was outlawed, silly. Mathlos Warku, I found really good out-of-state absentee houses, but I'm having trouble reaching owners. What do you recommend to deal with this? I'm not necessarily involved with a bunch of that, finding owners and off-market deal making, but I'm sure there's plenty of experts out there. Offhand, I wonder if like Ryan Pineda or somebody like that has courses on it. Somebody like him or Chandler David Smith or some of these other folks that are more actively scouting for deals. I think Ryan Pineda might be a good resource because I think that they have software and whatnot for doing that type of stuff. That's just not my gig. I'm just here to provide the financing, do some real estate investing, on a small scale with my wife, but nothing where, we're doing skip tracing and finding owners and sending out mailers and all the stuff I know other people doing at a high level. I'm not the one for that. OmniTrader, go ahead and send it to team@mtmg.com. Send that estimate over on that new build. We're happy to take a look at that and see if you're in something nice, because August, September, yeah, you can do a 60 or 90-day lock. Usually on the new build stuff, we're always recommended that you do it with some cushion, because they're almost never on time, builders at least, with getting things complete. Al Bundy, this is a great question. How many of your clients are selling a large share of their stocks to buy a house? Not a ton, but I will admit that there's a few that are selling out of stock positions, and they don't necessarily feel comfortable having their money in the stock market, and they're going to invest some or all of that money into real estate. Both the stock market and real estate, in my opinion, are long-term plays. I had this conversation with a client earlier today. Neither one should be something you look at month after month after month and are worried about, the ups and downs. If you hold long enough, either one of these assets, stocks or real estate, you're going to see them go up. But speculating or trying to be in and out of real estate or stocks in a speculative manner is just risky, right? And a vast majority of the people that I know that are creating a bunch of wealth through real estate are not speculating, right? They're finding a niche in real estate that they specialize in, or that they like, or that they're comfortable with, or that they understand better than the others. And they're going all in on that over a long period of time, right? Whether that's single families or duplexes, triplexes, and fourplexes, 12 units, commercial, office space, whatever it is, they have a niche that they know very well, and they do that. Some do it with Airbnb, some do it with office space, whatever it is, right? But it's not something that is going to make you rich in 6 months. It can make you very rich in 30 years. But the short-term speculation game is for Bitcoin, maybe. I don't know. A lot of people holding onto that for the long term too. All right. What do we want to look at? Inventory numbers. I don't know how many people are watching from Sacramento, but this is a really cool thing. If you go under Redfin's data, they'll show you where people are going from whatever market you're in. You type in your market as the origin, and then it'll show you where people are headed from your market. This is kind of hard to see, but I typed in Sacramento. 3% of the people that are leaving are going to Seattle. 3% are going to Portland. 2.7% are going to Dallas, Texas. Let's see if I could zoom in here. .4% are going to Reno, Phoenix, Arizona, Houston, Nashville, Las Vegas, Boise, and Atlanta. That's Q1 of 2022. I thought that was pretty cool, so I saved it on my desktop. If you go to like Redfin data or something like that, they've got all kinds of cool stuff. Another thing that I will have next week is more of this Altos research. I'm going to buy a subscription where I can basically go in here and get data on Sacramento, maybe some surrounding counties. Really cool data. Like I was talking about inventory here. This is the 7-day average. We're up to 937. It's up, and it's up a ton from last year and 2020, but still not as high as it was towards the end of 2019. I guess, look, if I look at July 19th of 19, it's 980. And we're looking at July 8th, 937. Pretty close to 2019 levels when you're talking about inventory. But Altos has so much cool stuff in here besides just inventory. You can look at like market action index, which is like comparing supply and demand. And as this goes down, buyers have more power. Sellers have less leverage. So we're still in a seller's zone, according to them. But this market action index is going down. 7-day average. Wonder why that went up. Tick up. That was interesting. I wonder what caused that little tick up over that 1 week period. Oh, maybe it was because there was less supply during the 4th of July week. Could that be it? Muy interesting. See, this was at 82 last month. We're looking at seller's market versus buyer's market. It's got to get way over to 30 to be a buyer's market. But like strong seller's market, this thing was probably in the 90s. 82 last month, 71 this month. As it starts to go further and further this way, more leverage for buyers. Buyers are going to have a chance. Next week, I'll link up. I'm going to pay for this Altos research stuff, and I'll have cool graphs, and you'll be able to go in there and type in whatever zip code you live in. Let's type in a random Phoenix. I think Phoenix is Starting to cool like a mofo, right? So last month it had a market action index of 80. Now it's down to 67. So it's cooling off. So yeah, I'll have a link to this. You can check out your market. It's pretty cool stuff. Stephen Henderson, one of my favorite topics. What are some other ways to purchase an owner-occupied residential multifamily 1 to 4 units with low down payments? Just heard it's a minimum 15% down for Fannie Mae. Yeah, the best way to do this is with FHA. Granted, you're going to pay mortgage insurance, but I was just pricing one up today. You can get mid-4s on the interest rate. Buy a 2 unit, 3 unit, 4 unit, 3.5% down. Really no better option when you're talking about like least amount of capital to close. What I would warn against, had a conversation about it earlier, is I wouldn't expect massive cash flow with such a small down payment. You know, the 2, 3, and 4s that I look at and that, you know, might be something that me and my wife would purchase, putting 25% down. If you're buying a nice property in a good neighborhood with good solid rents, it's not going to cash flow a ton, even with putting 25% down. You know, some people are 1031 exchanging and putting 40 and 50% down and getting cash flow. Putting 3.5% down, you can't have your cake and eat it too. You can't conserve your capital, only put a little bit down and expect to have monster cash on cash returns and whatnot. It's just not going to happen. The 15% down for Fannie Mae, honestly, too, is going to be single family. Even if you're occupying, if you're doing 2 to 4 unit, I'm almost positive you got to put 20% down. There was a caveat where if you qualified for Home Possible or Home Ready, you could do a smaller down payment on an owner-occupied multi-unit, but expect to put 20 or 25% down when you're going conventional. 3.5% FHA is really the only true low down payment multifamily product that's available. All right. I think I'm going to cut it short today. I got a lot on my plate. We got a lot of stuff to see. I'll come back next week with some more stats. Any questions you guys have, rapid fire them now while we're here. And I'm trying to get some real estate agent guests on over the next few weeks. I know I've got a lot of demand and requests from my buddy Ryan Lundquist. He's a local appraiser who does some real estate stats. We're actually doing an event on Friday. If you're local in Sacramento, send me an email, team@mtmg.com. Come join us. It's going to be a good event to join, but I'm going to jump off. And you know what I'm going to do? I'm going to listen to this in the background while I'm doing some work. This is Shahida Hill, Jeb Smith, and some others with no doubt some great stuff. So I'm going to copy this and put it in here. You guys go check these guys out. Say, Matt, the mortgage guy sent me here. I'll listen to that while I'm
emergency meeting. So you've got another CPA
while I'm doing work in the background. But for now, I got to roll. I got work to do.
And so
that's playing in the background. I can't get it to pause. But check them out. Coast to coast housing market discussion. Shahida's got some other great guests on there. My buddy Jeb Smith from down south. No doubt that's a good one. So go check them out. I'm out. Later. Until next time, we're going to see.